Welcome to the Climate Trends podcast, where we explore policies and innovations with people driving India's climate transition. I'm Archana Chaudhary, and in this episode, we delve into India's emerging carbon market, an important tool to help India meet its 2017 net zero target. And as we've been hearing, global carbon markets are systems that put a price on carbon emissions and allow trading of emissions credits or permits. And these should thrive on international cooperation and policy stability. But given the unusual geopolitical and trade volatility in today's world, the tariffs, the trade wars, and protectionist policies that are intertwining with climate initiatives, there are uncertainties being created. And we'd love to hear more about how these power plays can affect the development of carbon markets, especially for countries like India. Joining us today is Dr. Vaibhav Chaturvedi, Senior Fellow at the Council on Energy, Environment and Water. Dr. Chaturvedi leads research on low carbon pathways and carbon markets. His expertise lies in modeling long-term energy and emissions futures, informing both national and state-level climate policies. He's been instrumental in shaping discussions around India's carbon credit trading scheme, and which emphasizing the integration of financial players and robust regulatory frameworks to ensure markets' effectiveness. Welcome back.
Thank you, Archana, for having me, and thank you for this invitation. I look forward to the discussion.
Thank you so much. So let's head straight into our conversation today. Let's start with the basics for those who are new to this concept. Could you briefly explain what carbon credits are and why they've been considered an important part for climate action?
Sure. So, with the carbon credits, the first thing to start with would be, well, there is a larger decarbonization agenda, right? So we want to decarbonize for achieving it's not just about India's net zero, but there is a larger global imperative for us to achieve, low carbon emissions or net zero emissions to avert climate impact. Now, there could be various ways to achieve a low carbon society. There are different instruments, there are sectoral instruments, but this particular instrument which we're talking about, which is about carbon pricing, that instrument is an instrument that could be applied across sectors. And a lot of research has already shown and proven that this instrument is, in a way, the most efficient and effective instrument in some ways, as compared to many other instruments. So the option for governments is you could have policies that are focusing separately on, let's say, power sector, separately on industrial sector. So you could have all those policies also, or transportation sector. But carbon pricing is, you could say, a measure that could be applied across sector in a way that equally values carbon emissions across it, right? And that is very important because carbon pricing, I'm coming to carbon pricing before I am coming to carbon credit. The starting point has to be to understand what is carbon pricing, right? So carbon pricing is essentially, it puts a price on carbon, as it says. And what happens, the question is, what happens when you put a price on carbon, right? So imagine there are two technologies, let's say a solar technology and a coal technology, and both can be used to produce power. And at any given point of time, let's say coal is cheaper to produce electricity. So you could produce electricity at maybe 3 rupees per unit by using coal. Whereas for solar, especially solar with batteries, the cost is 4.5. Right? So automatically an investor, or especially in a developing economy where costs are very important, affordability is very important, it's very automatic that anybody would choose coal over solar plus battery just because it's cheaper, right? But let's say for a net zero imperative, if you want to change that equation, the question is, how do you change that equation? And a carbon price is very effective in changing that equation. So the moment a carbon price comes in, it essentially, between these two technologies, coal is the one which has carbon emissions, solar is carbon free. So automatically, based on the price of carbon, the cost of coal-based electricity will go up. So it depends on the level of carbon. If you just have a $1 price of carbon, the effect will be very marginal. If you have a $10, the effect will be, of course, a lot bigger. And if you have a $25 price of carbon, the effect will be a lot bigger. So for these different levels, depending on the level of price of carbon, the cost of coal-based electricity would change. So with a very low price, it would be maybe just increase from 3 rupees to 3.1 rupees. I'm just giving random numbers here for the sake of explanation. But if the price is $25, the price of coal-based electricity might increase from 3 to 6. Right? Just double. So the moment there would be a level at which the choice of an investor flips, right? Basically, the coal will become more expensive than renewable energy.
Mhm.
Right? So that's where the choice flips. And
Yeah.
that's how carbon price incentivizes low carbon options over high carbon options. So that's about carbon price. Now, carbon price can be implemented through different instruments, right? One instrument is a carbon tax. Carbon tax works like any other tax, any other, you could say, GST or value added tax, right? The way I've explained, it is like a carbon tax. So the government will say, I will put a carbon tax on all fossil fuels depending on the carbon emission value. A
Mhm.
carbon tax theoretically is different from a fuel tax, right? Because fuel tax is on energy value.
Mhm.
Carbon tax is on the carbon value. What does it mean? It means both natural gas and coal might have a very similar energy value for, let's say, a particular purpose,
Mhm.
right? For a particular purpose, you need, let's say, same amount of energy from a natural gas or a coal power plant for producing a particular thing. In that case, the energy tax would be similar. It would not differentiate between these because it's the same energy value we are using in both the fuels, right? The moment carbon tax comes in, that's when, because the carbon content of coal is higher as compared to natural gas, carbon tax will make it. It will make coal more expensive even as compared to natural gas, which has a comparatively lower carbon footprint, right? So carbon tax is one way to implement a carbon price. The other way, which many governments are using around the world very successfully, and what government of India has also chosen,
Mhm.
is what is called as a cap and trade.
Mhm.
So where you identify your large point sources, you say collectively, if their emissions, current emissions are 100 units, let's say collectively,
Mhm.
in future, I want in 3 years or 5 years or 10 years, I want to reduce from 100 to 70, let's say in a 10-year horizon.
Mhm.
The moment that happens, then all the compliance entities will start to or will have to undertake activities that mitigate their emissions, right? And the mechanism through which they will be incentivized to undertake that activity is carbon price. So the market will determine the carbon price. And I will not go into the very details, operational details at this moment, but it will suffice to say in the beginning that the market mechanism determines the carbon price. And the most important logic behind the cap and trade market is wherever it is cheapest to abate,
Mhm.
those sectors will abate. So in the example I gave,
Yeah.
where collectively 10 different kinds of companies across sectors have to reduce emissions from 100 to 70, the question is, who will undertake this mitigation? Because now we are talking about so many companies. So the market will ensure that only companies which have got the cheapest options available for
Mhm.
mitigation, they will actually undertake mitigation. But other companies, let's say a steel company, let's say
Mhm.
steel company has an option of green hydrogen, which is very expensive. A carbon market, which is like a cap and trade market, will actually not incentivize high cost investment. The market design will ensure that only the lowest cost abatement opportunities are harnessed first.
Mhm.
And only once you have harnessed the lowest cost abatement opportunities, it then moves up the ladder to more higher cost. In each step, it moves towards the next higher cost abatement opportunity available. And that is why for developing economies, cap and trade is excellent. It's very, very important because if you look at just sectoral policies, let's say the government of India can say, I want to incentivize green hydrogen in a big way. And I'm only focusing on this sector and I'm using a lot of money from a fiscal budget perspective to
Yeah.
push green hydrogen.
Mhm.
Now, from an economic perspective, that might not be the most sensible thing to do
Yeah.
because that's a very expensive technology. So it makes sense for a developing economy to actually first intervene where it is the lowest to mitigate, like which are
Mhm.
the cheapest mitigation options. That's the we mitigate because ultimately, whether you choose option A or option B,
Mhm.
ultimately you are mitigating the same amount of emission,
True.
right? So the idea for a developing economy should be cheapest possible options, right? And
So
and
you
a carbon market ensures it. I think that's the short of it. A carbon market ensures the cheapest possible abatement opportunity, and that is why governments are choosing it around the world.
so that is the big difference. I mean, that's very helpful to understand how carbon pricing works, as well as the difference between what happens if you have a carbon tax and what happens if you have something like cap and trade, and why India is
Yes,
choosing,
yes, yes.
which is very good to know. But what would also then be interesting to know is that if we are saying that by 2030 the demand for carbon credits is going to be multiplying by a factor of 15,
Hmm.
and we're going to have a market value that is as high as $50 billion, for instance, uh, according to estimates out there. Where does something like a voluntary carbon credits market sit? And
Sure.
why are we seeing such a surge in an interest about voluntary carbon credits in the last few years?
Yes, yes. So when I first answered the question,
Yeah.
I was actually talking about a very different, instrument, which is cap and trade.
Yeah.
Offset market is completely different.
Hmm.
So if colleagues in India who have experience of the CDM market, for example, which is under United Nations, or the Article 6, the new one that is being discussed, all the
Yeah.
voluntary market that you just talked about,
Yeah.
all of these are forms of offset market. See,
Okay.
I think the confusing part about carbon markets is there are many different kinds of animals within the same broader terminology of carbon market. So it's kind of very difficult to differentiate.
Hmm.
But technically they're very different. They're very different animals. The cap and trade is a compliance system. It's very different.
Yeah.
Article 6 is also compliance in a way because it is
Hmm.
under United Nations.
Hmm.
Still, it is offset market, right? It's not that collective cap and trade means like in the EU ETS, right?
Yeah.
So you
Hmm.
have a bunch of large point sources, compliance entities, which have together been given a particular target of reduction,
Yeah.
right?
Hmm.
Of the example of or the question about voluntary market that you talked about,
Yeah.
voluntary market does not deal with the aggregate, compliance regulated target, or not just voluntary, any offset market.
Yeah.
Offset market is more about there are particular kinds of projects which have to satisfy certain principles or certain conditions, like they have to be additional in nature. Additional simply means an investor uh, should not be investing in this project if it is already financially viable.
Hmm.
Well, I mean, they should be investing, but basically they should not be getting carbon credits. I think that's the
Okay.
big difference.
Okay.
So, which means in early 2000s, when a
Hmm.
lot of money came to India through CDM
Hmm.
for wind projects,
Yeah.
at that point of time, wind projects were very expensive. Probably 11, 12 rupees per unit was wind production.
Yes.
Now, of course, for a developing economy, I mean, there is no point in investing in a technology which is so expensive, right? So that is where, because it will be financially unviable, nobody will be buying it.
Hmm.
That's where carbon market came in. That's where CDM came in, which is an offset mechanism. So the differential between, let's say, coal-based tariff, which might be, let's say, 4 rupees,
Hmm.
and wind, which is 12 rupees, the differential has to be bridged through carbon market,
Hmm.
right? So
Hmm.
but that was 20 years back.
Yeah.
Coming to now cost of wind because of economies of scale and many other technology developments,
Yeah.
even the cost of wind-based power has declined, right? So right now, carbon markets will actually not be funding wind power because it's already a financially viable. Investor should anyway invest in wind power. Why do we need carbon credits, right?
Right.
But the moment there is wind plus storage,
Hmm.
which is another very expensive technology,
Yeah.
that's where carbon credits will come. So this is before your question about voluntary market. I just wanted to emphasize
Yeah.
that earlier I talked about cap and trade, which is a very different thing.
Yeah.
Now we are talking about offset markets. These two are very, very different things. The dynamics are very different. The whole logic and basics on demand and supply,
Yeah.
plus regulatory architecture,
Hmm.
plus operational mechanism. They are very different between these two.
Hmm.
So, yeah, it will be great if we focus on voluntary market. Then we will just discuss that part, and then we will come to the cap and trade. We'll just discuss so that we separate these two things out.
Yeah, so thanks for doing that, because then that gives us a good segue into our next question on how is India looking at this, and what is it that how is India managing both these models? We know that earlier this month India has come up with new rules
Yes,
for a few companies. If you could talk a little bit about that, and what are the challenges then for India in setting up carbon markets?
sure, sure. India is actually moving on both the fronts. So if you read about Indian carbon market,
Yeah.
it talks about CCTS compliance
Yeah.
and CCTS offset,
Yeah.
right? So now if you
Mm.
delve deeper into it, CCTS compliance is something similar to, let's say, the EU ETS or China ETS or Korea ETS, which is a cap and trade scheme, similar to that, not exactly that, similar to that, right? And CCTS offset is very similar to the voluntary market, right? So the government of India has actually kind of released things for both. So
Mm.
on the offset market, it has released a bunch of methodology that any investor can actually invest into a particular sector based on certain methodologies and actually generate carbon credits and sell in the market,
Mm.
right? So that's the offset market. Government of India has also released some notifications and some more information for offset market.
Right.
Your question probably deals more with the compliance one,
Yeah.
where Government of India has said that for these four sectors, we are giving them a particular target to mitigate, right? So
Mm.
that's about the compliance market. Now, compliance entities, what they will do practically, they will assess whether these targets are high or low for them.
Mm.
Let's say the target is, let's say, very strong target,
Yeah.
right? So any company will need to take a call that,
Mm.
okay, does it want to mitigate in-house
Mm.
or buy carbon credits from outside? So every company has got these two options, either to mitigate in-house or buy carbon credits from outside. When it mitigates in-house, that question is and both the question, not just one question, both the questions are also financial in nature. But as I said, ultimately the carbon market ensures that economy-wide the cost of a particular target are minimized, right?
Yeah.
So a company level, when I say company has to mitigate, what
Mm.
does it mean? It has to select mitigation technology, right? Mitigation technology comes with a price tag. These are costly technology, right? So depending on the process, depending on the choice of technology, it will assess what is the money needed for
Mm.
this particular intervention and what are the associated emission reduction it will achieve by this particular investment, right? As against this, the company also has an option to actually not do anything in-house,
Mm.
but buy trades from the market. That's the other option the company has got, right?
Mm.
So now the choice of the company boils down to what is the expected price of carbon credit in the market,
Mm.
expected price,
Mm.
and what is the cost of in-house mitigation.
Mm.
So it compares between these two. Let's
Okay.
say, I'm just randomly giving an example for, let's say, a big steel company,
Mm.
if investing in green hydrogen,
Mm.
let's say the per unit carbon cost is $60-$70. It is actually very expensive. Green hydrogen, as of now, given the
Ah.
current numbers, it's very expensive. So if you take the carbon savings because of a particular investment in green hydrogen and steel, essentially green steel
Mm.
making,
Mm.
then you would find that it will be at least $50-$60 per ton of CO2. Very expensive, right? So the question is, should that company actually invest from its own money
Mm.
in the particular option,
Mm.
or it actually buys carbon credit from the market to surrender to the government, right? So that is the option. So now in this particular case, because its own investment is so expensive, and it will make an expectation of carbon price in the market. That
Mm.
okay, when I in future means 6-7 months or 1 year from now,
Yeah.
if I have to buy carbon credits, what is the potential price of carbon credits in the market,
Mm.
right? Some expectations have to be made. So let's say, based on some information, if it finds that it can buy the carbon credit in $15 or $20,
Mm.
well, the obvious choice is it will buy carbon credits.
Mm.
It will not investing in house. It will buy carbon credits in the market, right?
Mm.
So that is one part of the equation. That is the demand side. For whichever company it is expensive, in-house mitigation, it will buy from the market.
Mm.
On the other side, the question is who will sell,
Yeah.
right? Who will sell these credits to this green hydrogen manufacturer?
Yeah.
Well, it is exactly the opposite side of the coin. Any
Mm.
company that for which the in-house mitigation option are a lot cheaper,
Mm.
it will also see what is the potential carbon price in the market. So it will
Yeah.
also see $15-$20 in future,
Mm.
but its in-house cost is only $5. So what
Mm.
it will do, it will mitigate a lot more than its own target,
Mm.
because each company has got target, but it will mitigate more than its target.
Mm.
And whatever extra it has mitigated, the
Mm.
carbon credits extra it has generated, it will sell to this steel company. And in this particular case, the carbon price will be between $5, which is this company's seller company's mitigation cost, and
Yeah.
$50,
Mm.
which is this company's buying cost. Somewhere in between, depending on the dynamics on the demand and supply,
Mm.
the real market price carbon will actually come down, which could be $15-$20 based on the many market dynamics, right? So this
Mm.
is how a cap and trade system works in practice. And this is how when the government has given the targets for different sector, different entities essentially,
Mm.
this is how they will kind of proceed, in the future in terms of their action.
And that is how a market will
That
grow.
is how that is how the market will be created. I think the
Yeah.
first part is just this is the first
Yeah.
phase of India's carbon market.
Yeah.
So yes, this is the mechanism through which market is created. Another very important element which is actually missing as of now
Mm.
is financial players.
Yeah.
Right. So when I said for each company,
Mm.
it is critical to see what is the potential price of carbon in the future.
Yeah.
So who will give that information? Now imagine a steel company or a cement company, they don't have an expertise of forecasting carbon price. They don't have an expertise. They are in a very different business, right?
Right.
So
Right.
they will look towards some independent information
Mm.
that what is the price of carbon, which will help them making their own investment decision. So that
Mm.
variable is extremely important. But
Yeah.
the question is who does it? So the best way to get it done is through giving or making some financial players.
Mm.
part of this carbon market because that
Yeah.
is their day job. That's what
Yeah.
they do day to day for shares, for commodities, for everything. They are
Yeah.
experts of that field. So they will assess all the information from all the different sectors. And then if you allow, let's say, derivative trading, which is like futures,
Mm.
right? So then it is not just a report. See, CW can also do a report, a very good report, a very good solid report.
Yeah.
But it is always very different from somebody who's putting money on the table. So when there are financial players in the market, they actually
Mm.
put money on the table and
Yeah.
they will say, I am going to buy carbon at $15 6 months from now. So that's like
Mm.
you could say a future, a forward market, that is
Mm.
created. Now
Mm.
that is the information that steel players and cement players and fertilizers players will actually use to inform their own decision making. But if you don't have financial players in the market,
Yeah.
none of that happens.
Mm.
It is actually not a good situation. If you don't have financial players, then it's very hard for all these companies to have any sense of future price. And then they will make random decisions. Everybody will make decisions,
Yeah.
but collectively, it will not end up being the most effective market because everybody is making some random decisions based on their own assessment and they are not experts of business. Right? So I
Yeah.
think right now, this is what is missing. Hopefully, sooner than later, the government will allow the market to open and allow financial players. They have a very important role to play for market making role to play in this,
Mm.
architecture.
So basically, that is the gap that needs to be filled and filled from both
Yes,
so that we are
yes,
able to move forward with this, not
yes,
just,
yes. So
okay.
that is one gap. That is
Huh.
only one gap, I would say.
Yeah.
Another big gap
Mm.
is companies always need some longer term certainty.
Mm.
Right now, the targets are 2 years.
Mm.
I think 2024 is the base year
Yeah.
and 2027 is the target year. So, right, so in the sense, 3 year hit window they've got, and we're already in 2025, right?
Yeah.
Now, I mean, we are talking about mitigation investments, right?
Mm.
These are big investments.
Yeah.
And these investments will be for anywhere between 20 to 40 years, depending on the mitigation technology.
Right.
So, I mean, just based on a 2 year horizon, why would investors make any rational decision at 2 year horizon? Any
Right.
ETS system around the world, be it Korea ETS or be it European ETS,
Yeah.
every regulator gives a 10-year long window.
Mm.
For example, in 2025, we
Yeah.
should have told the companies that we are giving you a 2035 target.
Mm.
So the moment you give them a 2035 doesn't mean only 2035. It's a
It's a
graduated thing.
long.
So you have
Yeah.
target for every year, but you give them a longer term certainty. You say 2035 target is also what I'm telling you
Mm.
right now. Now companies get very solid information that how
Mm.
aggressive the government is thinking. It is lenient, is it aggressive? What does it mean for carbon price? And
Mm.
what does it mean for options that are available for me as a company?
Mm.
And then they will make that decision. So now the
Mm.
government has given only 2 year target. So I mean the question is companies that are making longer term decisions. I mean it's a okay start, but I'm saying it is far from sufficient. One has to give them a longer term trajectory for more certainty for investment decisions.
So, A, to have actual financial players to be a part of of the system. B, to be able to ensure that there is policy certainty over so many years, and the direction is clear for these companies to be able to then make
Yes,
changes to their systems.
yes,
What
yes.
are the other challenges apart
Well,
from
the
this?
other big, I won't call it a challenge. I think the other big missing piece is
Yeah.
the exclusion of the power sector, which is very interesting.
Mm.
So across all the ETS systems of the world, power
Yeah.
sector is definitely included. In fact, China started only with the power sector, right? In India, it's very interesting. In India, it's like we have only chosen industrial sector,
Yes.
not the power sector.
Yes.
Power is indirectly there in the sense if for industrial sectors, the power related emissions, which are scope 2 emissions, they are also included.
Mm.
But we have assessed and all the sectors covered.
Mm.
If you just look at their energy usage, electricity versus fossil and all that,
Yeah.
it comes to around 27% of India's electricity use is what is already covered indirectly.
Right.
But I mean, we ideally should cover 100% of the power sector, not like 27, 25, 30%, right? It should be 100% covered, right?
Yeah.
So the argument that is being given in
Mm.
India for the
Mm.
exclusion
Yeah.
is that power sector is very complicated.
And that consumers
I
will be hit by those, that ultimately prices go up, then consumers are going to
prices go
be
consumers. So
affected by it.
it's a
Yeah.
sector where
Yeah.
prices are, it's a regulated
Exactly.
sector with price controls. The
Yeah.
distribution companies are in losses,
Mm.
right? Which is all true. Which is all true.
Yeah.
But
Yeah.
I think the question that comes to my mind, well, all
Mm.
of these challenges are equally applicable to for even the RPO trajectory.
Mm.
The RPO is very ambitious. So
Yeah.
if anything has to raise prices, the RPO will anyways do it, right? So I mean, it's kind of unclear to me why some stakeholders are saying that having an aggressive RPO is okay. It
Hmm.
will not mess up the distribution companies' financials. It will not mess up the affordability, but carbon market will mess up everything, which is not very logical to my mind. I mean, they both are policies. Both will intend to do the same. Both essentially will end up pushing more renewable energy or low carbon energy. These are just two alternative policies,
Yeah.
right?
Yeah.
And whichever is more aggressive will actually do more aggressive things, end up doing more aggressive things. So
Yes.
right now the carbon market is less aggressive and RPOs are actually a lot more aggressive.
Hmm.
So I'm not very convinced with this argument that because of this larger context,
Hmm.
if you don't have RPO, then I would agree. I would at least see this argument that you are introducing a policy which is pushing the power sector.
Yeah.
Well, we are already pushing the power sector through RPO. So
Hmm.
then why are we saying that carbon market will make an additional complexity? I don't think it will make. It is just a matter of us ensuring understanding it, that actually would not be anything additional complexity as compared to the RP, which are already there.
Hmm.
You know,
Hmm.
so that is the exclusion of power sector is another big thing. And
Yeah.
I will also give why I'm saying it is big thing because as I said, the carbon market works in the principles of least cost.
Yeah.
It is most important fundamental principle.
Hmm.
Otherwise, you could always have a suite of policies across sector. You can have
Right.
RPO here. You could have green hydrogen incentives in industrial sector. You
Right.
can have mobility incentives. And so different sectors, you can have different incentives, right?
Right. Right.
The carbon market is needed only because it minimizes the cost for the economy. So for a developing economies, as I said, it's very, very important. So you have to include low cost sector.
Hmm.
How will you minimize the cost
Hmm.
if you don't have low cost sectors participating in the market?
Hmm.
And power sector is the lowest cost sector. Technologies are ready. We just have to figure out the right incentives to even push further these low cost mitigation options.
Right.
It is odd that we have covered steel sector where option is a green steel, which is so expensive,
Yeah.
right? So we have covered a very expensive option.
Hmm.
We have taken out the least cost option away from the market schematic as of now.
Hmm.
Which then what's the point of the carbon market? Because it aims at achieving any target in lowest cost possible. So you have already taken out the lowest cost option. You only did the industrial sector, which are all more expensive, a lot more expensive, right? So, that's another big
So you're
missing piece.
recommending basically that we go back to the drawing board and see a few crucial things that need to be, because having policy certainty to be able to include low cost sectors, be like power, to be able to have financial players, economists. Last time when we had a conversation about this, to be able to have a wider conversation. Three things that you spoke about was about financial players, about being able to give players companies a longer policy direction, as well as be bringing in low cost sectors. From there, we want, if we can segue a little bit into understanding how the pricing itself is done uh, for carbon markets then in India, and who are the players who need to be now looking at this, who should be coming in and working on this a little bit more, because we know that B is already working on CCTS. What are your recommendations?
Sure. So I think when we talk about pricing, we
Yeah.
can look at from through two lenses. One is the conceptual basis, and second is operational
Hmm.
nature. Right. So the conceptual basis will be, I mean, as we know, it is going to be about demand and supply in any market. That's how it works. The question for this market is what drives the demand and what drives supply. Right? So here, at an aggregate level, one can say that if the cap is very stringent, cap means the target, right? The target
Hmm.
to achieve. In our case, India's case, right now, it is an emission intensity target. It's an absolute cap target. That doesn't matter so much. You could have a more stringent emission intensity target also, right? So it's not the variable, it's the stringency that matters.
Hmm.
So if the target is a lot more stringent, you could expect that the sectors which are low cost sectors, they of course
Hmm.
have to take mitigation interventions because you need to do more mitigation. See, the broader point, when you have a very stringent target, essentially you're talking about
Yeah.
collectively, all the companies will have to undertake a lot more mitigation as compared to a scenario where the target is more lenient target, right? So
Yeah.
the moment you
Yeah.
are doing a lot more mitigation, that means you are in the marginal abatement cost curve perspective, which is a very important variable, which only tells you
Hmm.
that in the initial part, they are low hanging fruits, which are essentially low cost mitigation interventions. And the moment you
Hmm.
exhaust their potential, The next step is more expensive than the last step. So you keep on rising up the curve. And at the end of the curve, you could imagine technologies like green steel, which are very expensive at
Right.
the end of the curve, or carbon capture and storage, very expensive, right? In the beginning, you could imagine power sector, a lot more cheaper, plus energy efficiency investment, which are a lot more cheap, right? So this is a curve. The moment you make targets a lot more stringent, it means you are kind of using the larger set of lower cost options because you need to do a lot more mitigation. So the moment you do it, you're automatically rising up the cost curve, which means price is going to be higher, right? So to simply put it, the more stringent the mitigation target is, price will be higher. Carbon,
Okay.
right? That'll be one rule of thumb. Second is about uh, the dynamic nature of technology evolution. For example, right now we are expecting green. We know green steel is very expensive, right? Let's
Yeah.
say the
Yeah.
government gives a 10-year long target, 2035 target. So our current expectation of a 2035 target, or sorry, 2035 price will be based on the current information about the cost of green steel versus solar, whatever is the current best available information, right?
Right.
Let's say
Right.
4 years down the line, there is a technology breakthrough that happens, right? A lot of research is happening across, not just in India, across the world, or let's say green steel and other technologies. Suddenly, we find that a new technology for green steel has come, which has made it a lot more ineffective. It reduces the cost by 50%. So,
Right.
sitting in 2030, let's say when we have that information, suddenly we'll realize that now the carbon price expectation has come up just because of that one big break, right? So, basically, technology cost, which is dynamic
Yeah.
in nature, is the second biggest variable. And the more progress you have in technology, or rather the cheaper at mitigation technology portfolio as an aggregate becomes. So I'm not talking about individual technology. One has to look at, like you could say, suite of or collective suite of or portfolio of technologies across sectors. The moment the
Right.
average cost, mitigation cost across that portfolio reduces, carbon price comes down,
Right.
right? So these two are the most fundamental variables, as I said, at the conceptual level. So the interesting part is one is driven largely by regulation, the other is
Right.
driven largely by research and development. So R&D generally happens in the corporate sector, right? It is, of course, it
Yeah.
could be incentivized through government intervention, but the big money comes in the corporate sector, right? In R&D. It should be that way, right? Whereas the
Right.
other
Right.
variable is totally regulatory variable. The stringency of a policy is completely regulatory in nature, right? So
Right.
when these
Right.
two things interact, that is what determines the price of the carbon in the market, and that is why things like how many sectors are involved are very important. So when I said power sector is excluded and when a
Yeah.
low cost option is excluded from the market, what does it mean? Well, it means that we should expect the carbon price should be higher because you have in this current market setup where you only have high cost sectors, where
Right.
if you haven't had a collective abatement cost curve which is rising in nature, you have already cut out the lowest cost part from that curve. So now
Right.
the even the lowest carbon price, potential lowest carbon price is actually a lot higher, right?
Pretty high.
So you
Yeah.
could imagine that cost being higher. But the second variable is very important. Second variable is regulatory. If the collect if collectively the stringency of policy is not there, it is, let's say, very lenient, then this
Yeah.
cost curve is moot actually. If nobody is demanding carbon credits in the market, if the policy is so lenient that everybody can do some things and achieve the target, what does it mean? It
Yeah.
means there is no demand in the market. That's what we also saw with the PAT scheme, right? That was the
Yeah.
criticism of the PAT scheme, that the targets are lenient, so everybody can achieve the target easily. There
Right.
is no demand of credits in the market, so of course price goes down. So even if you have a limited set of high cost sectors, if the policy is very lenient and each sector can actually
Yeah.
meet its target through very basic investments like energy efficiency, then you could expect no demand in the market and a very low price. But that price is actually not driven by the supply side, which is the cost, technology cost, right? Where
Right.
it is actually driven by the policy with the regulation, which is actually very lenient. So you will see a lot lower carbon price in the market. So
Right.
as I said, these are all of
Right.
these different dynamics that impact the price expectation.
It's interesting what you're saying, but bringing in low cost sectors and widening the base and having more, of course, stringent demand, making a more, keeping your standards higher does sound like a good a good part to take. But just to play the devil's advocate, how does this affect uh, the cost if you were to widen the base and you were to bring in low cost sectors also into this? How will this affect the economy as a whole, especially inflation, especially prices of energy? At least in the short term, will it raise it? Will there be pain? Is that one of the things that is keeping the government from looking
Yeah.
at it?
Well, I think the question, this is a great question because this is a very fundamental question. And the big confusion that I see in general stakeholders is that the cost question is attached to the carbon market, which is incorrect framing.
Hmm.
The economic cost question is not at all about carbon market. The carbon market is just
Hmm.
one of the alternate, like many alternative instruments. So economy-wide inflation could happen. That is not a result of carbon market. If you use any other instrument and actually
Hmm.
drive a lot more mitigation, it could happen through that instrument also. So the inflation question is actually completely aligned with the ambition of your decarbonization target, economy-wide,
Okay.
right? So let's say I'm
Hmm.
just giving you a random example. Let's say government of India wants to now suddenly look at 2050 as the net zero instead
Hmm.
of 27, right? What does it mean?
Yeah.
It means emission peaking definitely has to happen by 2030, before 2030. It has to happen for achieving
Right.
a 2050 net.
Right.
It means a
Right.
lot more pressure on mitigation actions across it, right?
Hmm.
Now it doesn't matter you use carbon market to achieve it, or you use RPOs to achieve it, you use green hydrogen incentives to achieve it. That doesn't matter.
Hmm.
Because your decarbonization is so tight, it means there is going to be economic cost. So the notion of economic cost and inflation kinds of
Hmm.
variable that in some way denote economic cost and all that, it is
Hmm.
completely tied to the stringency of policy, not to
Right.
the choice of instrument, right? So you can use carbon market as an instrument, but
Hmm.
aligned with our 2070 net zero,
Hmm.
you will see inflation and economic cost when the screws started getting tight. Let's say around
Right.
2040. But as I said,
Right.
that's not a carbon market question. That it is an instrument that is used to implement the higher level target that the government or the society has chosen. Right?
Right.
You use any other instrument, you will actually end up getting the same kind of inflationary effects in the economy.
Hmm.
Right? So
Hmm.
carbon market is
Hmm.
best because it will actually allow, given that stringency of the target, it will still allow you to achieve it as the lowest cost. It is actually the best instrument. But
Hmm.
as I said, the lowest could still be inflationary, but that is not because of the instrument. That is just because of the choice of the stringency of the target. In fact, between two instruments, carbon market will lead to the least inflationary pressure because of this
Hmm.
cost logic that I told you, right? If you have an
Right.
economy-wide carbon market where power sectors and all sectors are included, carbon market will ensure that the lowest cost opportunities are harnessed, which means least
Right.
inflationary pressure if it had to happen. If you don't include the low-cost sectors, and I mean that
Hmm.
of course means that the sectors that are there, and if the target is a bit stringent, you will see a
Yeah.
lot more impact on those sectors. Carbon market actually helps you
Hmm.
to get away with the high cost implication. And that's the whole logic, You want to have carbon market
Hmm.
so that the pressure on economic cost and inflation is minimized to the extent possible. It will not go away. Let's not assume that achieving net zero is costless. It is going to cost the economy something. We should
Hmm.
be in some way implicitly, we have agreed to pay that
Hmm.
cost, because of climate impacts are happening. So we have
Yeah.
agreed to, as a society, as a government, we have agreed to take on that cost. The question
Yeah.
for us is now, how can we minimize that? That is the question. For which
Exactly.
carbon market is actually the best instrument to minimize the cost.
That's an interesting point you're making. Uh, and also to be able to find other ways to minimize the cost, the impacts on the larger society,
Yes. So
having to pay it, but
yes,
managing it.
yes, yes. That
So that's the
that
thin
you
line.
will need to do anyway. See, I mean, you could say the first element is as I said,
Hmm.
one should always look at the fundamentals first, and then let's say
Hmm.
the you could say trickle down effects in some, right? So the fundamentals are that any policy you take, if your target is stringent or has to get stringent in the future, let's say after 2040, our targets will have to become a lot more stringent. So
Hmm.
depending on the stringency, there is going to be cost of the economy. That is a fundamental, right? The
Hmm.
second fundamental
Hmm.
thing is carbon market as an instrument allows you to minimize that cost and minimize that inflation.
Right.
That's another fundamental.
Right.
The third
Right.
question is about trickle down effect. So the cost is minimized, but still there is some cost which will have to
mm,
be passed on, right? So the question is,
mm.
how do you distribute that cost, right?
Right.
So that is where you have to have a set of policies that ensure that the distributional implications are managed.
Mm.
So if there are you could say low income consumers, you have to have
Right.
a associated policy for which is electricity pricing policy that ensure that
Mm.
prices are not passed through to that section of the society. So this is just an
Right.
example. You have to have
Yeah.
have to have those kind of policies because we for India, which is a developing economy, we don't
Mm.
envisage that in 20, 25 years from now, poverty will go away. That suddenly everybody
Right.
has become rich. Of course, we are growing and we are becoming richer as an economy, but we should know
Yeah.
practically that there will be weaker sections of the economy, even like 30 years from
Yeah.
now.
Yes.
But that question is you have to figure complementary policies. So
Right.
as I said,
To ring
to ring
fence.
fence it. But
Yeah.
but
Yeah.
if people start viewing it as carbon market is increasing the cost, so let's throw down the carbon market is a very illogical because then you end up choosing
Right.
other policies which actually have more inflationary effects. It is the difference is other policies don't work in such a visible way. Carbon market has a carbon price as a variable. Very easy for everybody to
Mm.
understand. So everybody will say, look, the price of carbon is $20 and look, it is inflation in
Right.
nature. So people can make that judgment. But the reality is
Yeah.
other policies also have a budgetary implications. They will also have a cost.
Yeah.
It is just that they
Yeah.
don't come associated with this, high decibel variable that everybody wants to look at, which is carbon price. They don't come with that variable. So
Right.
they, in this political economy, they very easily are hidden below the carpet. But well, there is
Mm.
going to be fiscal impact. There is enough analysis to show that the carbon
Yeah.
market is the best possible instrument for managing all of these pressures. But the political economy, which is about the carbon price, the visibility of the carbon price, that's a very different
Yeah.
question. How many stakeholders perceive it? But it's not
Mm.
that their assessment is the right assessment. That's what I just want to say very clearly. Yeah.
No, fair point. It's a very fair point, and a very very important point also to be able to explain what are amongst the biggest challenges in rolling this out the way ideally the policy should be rolled out. But then the other question that also comes in is that since this is going to be part of a larger picture, right? Every country is trying to do this. Every country is
Hmm.
setting up systems like this. Uh, yes, you have studied the EU ETS so well. Uh, Given what we're going through in the geopolitical, because we are talking about the political economy, but the larger political economy globally, how does that affect the choices that countries like India then make? And what needs to be watched out? I mean, if we're keeping our focus on our net zero and we're keeping our focus on creating, transitioning our economy, how does India deal with what's happening overseas and what implications can that have on carbon markets rollouts?
Yeah, yeah. So I think that's a very important question. That this is, I mean, we know how the geopolitics is evolving. It is not evolving in the most conducive kind of direction, and it will have an impact on the larger decarbonization effort. It does appear. It's not just about what Trump is doing. See, even in the last COP, if the finance goal is not met, of course, it is going to be disappointing for the developing economy, and it's not just about an emotional disappointment. I mean, the question is, it needs real finance to achieve
Yeah,
mitigation, and if you don't give that kind of support, it is going to be in reality, it is going to be very challenging for developing economies to up their ambition. So
right.
it's not just about Trump. It will be this story will be before Trump and it will be after Trump also. If you don't get finance,
Absolutely.
it is going to be challenging. It
Absolutely.
doesn't matter who is in power in which other country, right?
Right.
But given all
Right.
these headwinds and all of these developments that are happening, uh, the
Mm.
larger question is what does it do for ambition in development? So as I said, I will broaden
Mm.
the question. My question is not about carbon market. It ends up being an ambition level question, right? For example,
Mm.
this NDC, which is going to be submitted sooner now this year by all the many countries, what is
Right.
the level of ambition which will come from India or other developing economies, right? Given all of this
Mm.
context that is emerging, right? And
Yeah.
if this new developments, especially the finance related developments, they lead
Right.
countries to choose lesser ambition, right? It's not an outcome of carbon market. It's just an outcome of the larger geopolitics, lesser ambition. But the lesser ambition will also pass through in carbon, which means the
Mm.
emission intensity targets that have been chosen. Everything has to be aligned with NDCs at the end of the day. Even if it is not stated
Right.
explicitly, it has to align. So if your NDCs
Yes.
don't become very ambitious, well, of course, the underlying instrument, carbon market is just an instrument. I'm emphasizing again, time and again, that carbon market is just one of the alternative instruments available. It is just the most effective instrument available. And that has been proven by far now. So, of course, that reality of, let's say, lesser for India, it is given our, economy per capita income, whatever we are doing is anyways a lot more ambitious. But compared to the expectation of the world expects India to do a lot more. Now that ambition is not going to come, and which will also be reflected in the carbon market start. And in fact, it will be reflected in all of the time, not just about carbon market.
Mm.
It will probably be reflected in
Mm.
RPO targets. It will be reflected in any other incentives we give across sectors. So it is a larger question about how geopolitics will impact ambition setting between countries, and all the instruments
Mm.
that any particular country chooses will reflect that
Mm.
ambition, to operationalize that particular ambition.
If you could also maybe talk a little bit about, because what you're saying is an important part. Yes, COP29 was a disappointment. Uh, Trump Trump's policies have also created a lot of uncertainty. But there was also border taxes that countries in the EU are looking at. There are, so how do those trade barriers, do they also play into how carbon markets in India are developed, or how carbon pricing is determined across the world? Do you,
Yes, yes,
since we were talking about pricing before that, if you could just talk a little bit about
yes.
it, would
So,
be
so
helpful.
let's say there are two markets. This is EU ETS market and India ETS market. The
Right.
carbon price trajectories could be very different in both of them, right? But the fundamentals are same. Fundamentals mean, as I said, stringency of policy. That's the first fundamental. Plus
Right.
technology opportunities available, right? Mitigation technology opportunities available. So if EU
Mm.
and India have very different policy ambition, which is clearly EU has
Mm.
2050 net zero, India has 2070 net zero. And one should not say India is less ambitious at all. India's ambition is nationally determined based on its own national circumstances, which are essentially low income economy and equity
Yeah.
concerns. So those are very important concerns. So it's not just about comparing net zero years, but how the carbon market sees. Carbon market only
Mm.
says in one, it has to be achieved in like 25 years, right? And in other economy, you still have some room to grow the emission for next 10, 15 years, right?
Mm.
This
Mm.
will, this information will inform the price formation, right?
Mm.
Which means in EU ETS, in let's say 2040, 2045, carbon price will be very high
Mm.
because you would have
Mm.
effectively already taken care of all the low cost mitigation opportunities because you are
Mm.
mitigating continuously, right? You will already have, addressed all those opportunities or harnessed all those opportunities. And the last
Mm.
options available will be very expensive. So carbon price will be very expensive closer to, let's say, 2040 because 2050 net zero is right there for EU.
Mm.
For India, we
Yeah.
expect emissions to continue to increase in 2040. And
Yeah.
then after that, that sudden you will see a shift in curve will happen. And then emission will, the price or emission mitigation starts happening in a stronger way. And that will be
Yeah.
reflected in price. So price dynamics are very different. The fundamentals are same, but the
Yeah.
information behind these fundamentals are very different
Mm.
across different kind of markets. But
Mm.
the CBAM is a very different question. See,
Mm.
the very interesting part, if you look at the carbon markets debate, like 20 years back, in fact, my
Mm.
PhD thesis was on global carbon market evolution. The interesting
Yeah.
part was at that time, which was in like mid 2000s and all,
Yeah.
the debate was about having global carbon market. So everybody was
Yes.
saying that most efficient instrument, let's have a global carbon market. And
Yeah.
India and all the developing countries have lower cost mitigation opportunities, which means
Yes.
mitigation will happen here, but through carbon market, a lot of finance will come to India and the developing. That's the whole point
Mm.
about carbon market, right? If you have a global carbon market, then wherever it is cheapest, that's where mitigation happens. Cheapest and also feasible, but these countries also get the money, which is the climate finance part. The debate was about a global carbon market. It was a very interesting debate. There will be a market and the developing world where lowest cost abatement opportunities are there. That's where a lot of mitigation will happen, but they will also get a lot of money because through carbon market that it will flow. That was
Right.
the debate. Of course, politically it didn't flow anywhere because the moment it is a global carbon
Mm.
market, who will decide, who will allocate? Because ultimately carbon market is also about allocation. at the individual level. So you have a global target, but you also allocate certain rights to countries. That's where it fell apart, right? That's a question nobody can solve ever. So that was a debate. Very interestingly, now you
Right.
see that through this CBAM and all, that is, it appears to me, at least a part of that debate is coming via backdoor, because these are unilateral actions. And now,
Hmm.
interestingly, many developed world countries are thinking about the same. In fact, the US also had a proposal before Trump, right? So for all we know, after Trump
Hmm.
goes, then whoever comes next, whichever government comes next, especially if it's a Democrat government,
Hmm.
they will probably restart it. And maybe
Yeah.
Republicans might be happy because it's also another form of tariff. CBAM is also another form of tariff. It
Yeah.
might align, so they might be disagreeing with the climate part of it, but it's a tariff measure, unilateral border measure. So
Hmm.
what we are seeing happening, all the
Right.
developed world countries, like UK is considering, Australia is
Hmm.
considering, US already has it, Japan, Korea also, it's also a high income economy. All of these are Canada, all of these are considering this something like that,
Right.
unilateral measure, right? And if you look
Right.
at the import
Right.
versus
Right.
export divide in the world, a lot of export actually happens
Yeah.
from the developing to the developed world. Because I mean that's where the labor cost
Absolutely.
advantage and those things are
Absolutely.
there, right? So the
Yeah.
export which is
Yeah.
developing to developing is there. It is not the bulk of the global export,
Hmm.
right? So you could very well imagine that
Right.
at least the export
Right.
in the export and global trade part of it, if all the developing countries start doing unilateral measures, then you have an
Hmm.
effective price in a lot of on a lot of production in the developing world
Hmm.
also, right? So the only thing that
Right.
will be left out is production in developing
Hmm.
economies that is exported to developing economies, as well as production that is used for domestic consumption. So that part where
Right.
CBAM doesn't impact that part, but everything else, in fact, CBAM
Yeah.
by 2034, it is also saying that even if
Hmm.
India exports to, let's say, Korea, and from Korea it is exported to
Hmm.
EU, even then India will be facing the carbon
Yeah.
tax. So it's not just the direct exports to EU. Even
Right.
if your exports are routed through any other third economy after some value addition, even that is going to be also covered under
Hmm.
CBAM. So it is a lot of exports
Okay.
across countries will be covered. So in some way, you are essentially imposing a carbon price which is at the level of the developed world carbon.
Hmm.
So carbon price in EU and all is going to be very high.
Yeah.
So especially for
Hmm.
economies that are majorly export-oriented economies, developing economies, they are going to face it
Hmm.
in a big way.
Hmm.
For India, I mean, unfortunately, it's not a good thing, but unfortunately, we are not the biggest exporters in the world, right? Of course, it will not
Right.
impact us in such a
Right.
big way as compared to maybe East Asian economies, right? But there will be some
Hmm.
effects on global growth and trickle down effects on India, plus all the exporters
Yeah.
are going to be hit. So this is a new thing emerging.
Right.
There is a link to domestic carbon market also, because whatever price
Yeah.
within the domestic carbon market is faced by these entities, right? They can set it off
Hmm.
against the price they face in the EU. For example, if India the carbon price is $10 and the
Right.
EU's carbon price is let's say
Hmm.
$100, then the $10 part
Hmm.
will be set off, but they will still have to pay the $90,
Okay.
right? So yes, there is a link,
Absolutely.
but these are. I think your question is a larger question. I mean, it's a international trade and carbon
Yeah.
price role in international trade question, which is in some way delinked to the domestic
Yeah.
policy question. Because interestingly, if you look at
Yeah.
the CDM era, the earlier era, uh, that time the debate or the
Hmm.
motivation behind the carbon markets debate was that carbon markets was
Yeah.
primarily viewed as an instrument for international climate finance. Okay, that's very important. It was viewed as an
Hmm.
instrument for international climate finance. What did CDM do? It essentially
Right.
transferred money from the developed world to the developing world. The global carbon markets debate that I just talked
Right.
about, that actually didn't go anywhere. The motivation behind that debate was also something
Hmm.
similar. Money will come from the developed or developing world,
Hmm.
and globally mitigation, will be going up, something like that. But with domestic cap and trade,
Yeah.
the motivation is not at
Hmm.
all international climate finance. Now the primary motivation is domestic
Hmm.
decarbonization. So you could see in the framing
Hmm.
itself, it's very different. One is,
Hmm.
how do you view carbon market? Do you view
Right.
these as instruments for international climate finance, or do you view these as instruments for domestic decarbonization? Those are two very different things, and they
Right.
really matter a lot. Now, CBAM has introduced another thing. CBAM is saying it is not even a
Hmm.
domestic instrument for domestic decarbonization. It's not even an instrument for international climate finance. It's an instrument for a third
Yeah.
country to push a third country
Hmm.
for decarbonization. It's a new
Exactly.
thing that has emerged in the
Exactly.
carbon markets
Yeah.
debate now, that the price is set up by a third country. It's not India's
Right.
carbon price. EU will be setting the carbon price that will be levied on India's exporters, and India's exporters will have to
Right.
decarbonize, or they pay the price and face the competitiveness effects of the same. So it's a very interesting way
Hmm.
for them to
Hmm.
actually decarbonize productions which are beyond their borders. So that's what they are actually doing.
Yeah.
Hence the
And
big
hence the
pushback.
pushback. Yes. Absolutely. Yeah. But then coming back to this, and we'll try and wrap up today's excellent conversation with you. Learned a lot from you. Thank you. But if you can tie this back to then going forward, if we can just summarize again, what should India be doing when it is now moving forward with its CCTS? What should be the top things, that priorities that we should move on, and what how does that benefit us when it comes to domestic resource mobilization, at least for our own
Yeah. So as far as CCTS
decarbonization?
is concerned, I think you already listed those three things that I talked about. One is definitely give a longer term certainty to
Yes.
investors. So horizon should be 10 years. And the
Yeah.
most logical
Yeah.
way to do it is align with NDCs. Very simple, because NDCs are
Hmm.
mandatory. They're going to be announced in advance, like in 10 years advance for every cycle. So if you align with the NDC, then you
Right.
give a formula, whatever that formula is. You could say NDC's emission intensity target plus 5%. I'm just randomly giving a formula, whatever be the
Okay.
formula. But the moment you align with NDC, it makes the job very easy,
Hmm.
right? So that's the first point. Longer term certainty is very important, and aligning with NDC for that
Hmm.
purpose makes sense. Is easy thing to do. That's one thing. Second is about
Hmm.
including financial
Hmm.
players in the market, because otherwise there's no way for us to inform price formation process. Who will do it? Is the financial players will do it. We ring fence it, but they should be included. We should not be worried. Right now there is a worry. The worry is also not baseless. The worry is the moment
Hmm.
you include financial players, they will mess up the market, which happens. Of course, we know financial players are
So
difficult to handle also, right? So we should know that. But that
yeah.
doesn't mean that you simply say that we shut our doors to financial players. That doesn't make sense either, right? So you include financial players, you ring
Hmm.
fence them, but you definitely have to include them. That's the second part.
Yeah.
Third, inclusion of power sector.
Yeah.
That's very important. Include power sector
Hmm.
in the market. It brings low cost opportunities.
Hmm.
So these are three things. The fourth thing I would say, there is always a role of complementary policy. Carbon market does not necessarily
Hmm.
mean that that's the only instrument in the economy. There could be a role of
Hmm.
complementary incentives. Like, for example, FAME incentive, there could be green hydrogen incentive, because we know carbon market will never push high cost opportunities, as I said, right? But if you want to push green hydrogen for
Yeah.
strategic reasons, there's nobody stopping us from giving incentives to green hydrogen. We should do it. The role of complementary policy is very important. You just
Hmm.
have to think about which complementary policy.
Hmm.
I don't think RPO is the right complementary policy with a carbon market, if power sector is included, because they both have very similar approaches,
Hmm.
very similar way of impacting the decision making process. But whichever are the right suite of complementary
Hmm.
policies, the economy has to figure it out. That's very important. And the final point I want to make is, sooner than later, we have to move towards an auction process, because this whole process of
Right.
government giving target, what does it mean? I think one of our papers, journal paper that was published on carbon markets last year, very interesting insight. When
Yeah.
the government chooses target, effectively what it is doing,
Hmm.
government is choosing financial transfers across
Hmm.
it. And that is, I think it's fantastic insight. So when
Right.
the government says that
Hmm.
steel sector's target
Hmm.
are lenient and cement tech sector's targets are stringent, what does it mean? It is implicitly
Yeah.
forcing the cement sector to buy more from the steel sector. I'm just using a simple
Hmm.
example of two sectors only, right?
Hmm.
So you're forcing the cement sector to buy from steel sector,
Right.
which means cement sector is giving money to the steel sector. There's a financial transfer happening across sectors, right? And if the government completely flips it
Right.
the other way, if the government says steel sector is more aggressive targets and cement is lenient, it has completely changed the flow of finance, right? So this whole business
Right.
of target setting for companies and a sector, it's very tricky.
Hmm.
The political
Mm.
economy is very complicated. And as I said, implicitly, the government is choosing financial transfer across sectors. Ideally, that financial transfers across sectors will happen, but they should be based on wherever it is
Right.
cheapest to mitigate. Some economic efficiency principles is what it should drive. It should be driven by, and that will only
Right.
be possible if
Right.
you introduce the auction process, even if it is a partial auction process. So you give 50% allowances for free, but for other 50%, you say
Right.
auction process, right? But and then you move towards 100% auction, maybe 15 years from now. So, but the larger point is do introduce
Mm.
auctioning, even partial auctioning at the earliest possible, so that you get more information from the market, from different companies and sectors, so that you
Right.
government should step outside from this whole business of allocating permits, which essentially implies financial transfer across sectors. That's what it means, bottom line. The government should exclude itself from that business.
Mm. Right. So, minimum
Yes, yes.
government, maximum governance, which is the policy. Okay. But this is very helpful and extremely grateful to you for making the time today, Vaibhav. It's clear that carbon markets are not a silver bullet. They are a strategic lever that can help in shaping our future, provided we are able to design it well, provided we are able to deal with it with good faith policies, and like you said, include more players, financial players, and bring in those who really matter for this tool to be able to be effective, uh, along with our climate ambition being high. So, thank you very much for making the time to join us. It was a pleasure having you, and we hope to see you again
Thank you,
soon.
Archana, for this presentation. Yeah, a very interesting discussion, and the questions were and very important questions that you asked. So very happy to be a part of this discussion, and looking forward to continuing this collaboration.
Thank you, viewers, for listening in, and don't forget to subscribe to the Climate Trends podcast for more conversations that help us decode the shifting path forward for a sustainable, self reliant, and resilient India. Thank you.